The U.S. stock market made a dramatic U-turn today, with the Nasdaq rallying 2.5% to reverse yesterday's steep tech sell-off. Sentiment shifted from extreme caution to relief as geopolitical risk premiums collapsed in a matter of hours. This index recovery shows how sensitive corporate valuations are to shifts in macro risks, especially when energy and supply chain security are in play. The primary trigger for today's market rebound was a surprise announcement from President Trump. He stated that the United States has reached a major settlement agreement with Iran, prompting him to cancel planned airstrikes. While Iranian officials have remained cautious, stating that a final conclusion is still speculative, markets moved immediately on the prospect of a diplomatic resolution. The core of the proposed agreement involves the reopening of the Strait of Hormuz, a critical transit choke point for global energy flows. Trump indicated that negotiations are set to launch for a 60-day window regarding regional security and maritime transit. If signed this weekend by Vice President J.D. Vance in Europe, the deal would significantly ease naval blockade risks in the region. Energy markets reacted instantly to the news, with Brent crude oil crashing below $90 per barrel, down to $89.91. This drop indicates a rapid unwinding of the geopolitical risk premium that has pushed fuel costs higher over the last month. Technicians note that if oil remains below the $90 support level, it could signal a medium-term peak in energy prices. While lower oil prices could ease inflation fears in the future, today's official data showed that inflationary pressures remain hot. The U.S. May Producer Price Index accelerated to 6.5% year-over-year, its largest 12-month increase since late 2022. Final demand rose 1.1% in May, driven primarily by gasoline and energy costs prior to today's pullback. Compounding these domestic inflation concerns, the European Central Bank announced its first interest rate hike in nearly 3 years, raising key rates by 25 basis points. The ECB cited rising energy and commodity costs from Middle East tensions as a major driver, raising its inflation forecast to 3% for the year. This global hawkishness suggests that major central banks are still in tightening mode. U.S. equity market liquidity has also faced short-term constraints as institutional investors locked up capital for major upcoming listings. Portfolio rebalancing for the large space tech offering has temporarily drained cash from mega-cap tech stocks, though this pressure is expected to ease once allocations are finalized tomorrow. While liquidity shifted, AI-related hardware demand showed persistent strength as Western Digital, operating under the SanDisk brand, surged 14.5% to new highs. Hyperscale cloud providers have booked out almost all production capacity for flash and memory through late 2026. This shortage is intensifying as manufacturers prepare for the rollout of next-generation GPUs, driving memory prices higher. In contrast to storage suppliers, infrastructure provider Oracle saw its shares tumble 8.5%. While Oracle reported strong backlog growth, investors are increasingly concerned about the heavy capital expenditures and debt financing required to build out data centers. The rapid pace of hardware iteration means companies risk high asset depreciation before these data centers generate net profits. Adding to Oracle's valuation pressure is a major concentration risk in its backlog. Analysts estimate that out of Oracle's $638 billion in remaining performance obligations, over $300 billion is tied to a single customer, OpenAI. This concentration creates a single point of failure risk, linking Oracle's long-term revenue to the financial viability of one AI lab. This debt-fueled expansion has led macro analysts to draw parallels to the fiber optic bubble of 2000. Back then, massive capital was spent building out networks under the assumption that demand was infinite, leading to capacity gluts and bankruptcies when the market saturated. While AI technology is transforming industries, the risk of overbuilding data centers remains a concern for capital-intensive infrastructure plays. Looking at the broader credit system, macro research suggests that commercial real estate losses are beginning to impact consumer credit. As banks write down CRE loans, they are tightening standards for auto loans and credit cards. This transmission mechanism could crimp retail liquidity in the coming weeks, especially as households face high living costs and rising interest rates. As we head into the weekend, the market's focus will remain on the actual signing of the U.S.-Iran agreement and whether the Strait of Hormuz successfully reopens. We will also monitor crude oil prices around the $90 support line and watch for credit tightening trends. These factors, alongside upcoming Fed comments, will determine if today's Nasdaq relief rally can sustain its momentum.